Good afternoon, traders. This is Michael and Paul coming to you from GammaEdge on Sunday, February 20th. You can follow us at GammaEdges on Twitter or www.gammaedge.us is our link. Today we're going to be doing a weekly review. We're going to look at some gamma charts on the PBI. We're going to go over the tick and what it looked like through the week, and then we'll look at some technical analysis on the SPY and some important levels moving into this next week. Go ahead, Paul, and take it away.
Great. So thanks, everyone. Always like to start with the market. And just like we do every day to begin the day, let's just take a look at where we've been this week. And as we know, it's been chop, chop, chop. What you're looking at here is the cumulative tick, Friday, Thursday, Wednesday, Tuesday, Monday, and you can see that it looked like we were gonna, in the beginning of the week, Tuesday, Wednesday, we were going to try to recover and make some progress on the long side. In fact, during the middle of the day, you can see on the right around 1400 or 2 o'clock Eastern time, we did take off pretty strongly, and it looked really, really good up here on the SPX and the COMPEX, but was not to be. Thursday started fairly weak, straight down. We call this a linear down. And then it abated for a while, and then into the afternoon session, it just sold off. And then Friday was just a continuation of the same. It looked like the first 30 minutes or so, we dropped a little bit and we were just going to hold. And then for the rest of the day, it was just risk off. This is a big deal. A couple things everyone should be aware of. While the cumulative tick, this white line, gives us kind of the instantaneous read on the market of sentiment, these moving averages that you see here tell us historically where we've been in terms of above or below. And when this slower moving average, which is the cyan line, this blue line, when it's above everything else, that means that we've spent more time historically below this thing than we have above. So what's this tell you as a trader? We keep attempting to move up and we fail. And this tells me as a trader that I should be shorting any rally at this time. Until we can get above and start doing something there, and sustaining the move above longer than 3 to 5 days, it's very, very tenuous. Now, that being said, we could get some signals that do push us higher, but right now we're not seeing it. I'd be looking for something that looked like this, where we have a very steady linear up over the course of several days. This was back February 9th, February 8th, but we're not there, and we're not seeing that now, and as a result, this is clearly risk off or play the downside until it's not. So we'll see where we end up there. One of the key things that we also look at is what is the overall gamma condition for the market. And the key takeaway is that when the gamma condition is negative, expect higher volatility. And why that's important is that you're going to see more intraday swings, and that's going to directly impact your psychology. The greater the swings that you see, the more perhaps your long positions are going to go underwater, or perhaps your short positions are going to go underwater. And that's going to play havoc on your rules, on your mindset, on cutting your losses and things like that. So always take a look at the market condition, then take a look at what is the overall structure of the gamma condition. Right now we're negative, increased volatility. Dealers are selling the dips down and perhaps would buy the rips if we were to go up, but that's not assured. Some key levels that we're looking at for going into Tuesday morning are the 4,300 level. You can see this very big dominance down here. We ended here at 4,350. So knowing that we're kind of sandwiched between the 4,400 and the 4,300, we're it's very realistic to play in this area. Note if we lose 4,300, we have the potential of coming all the way on down to 4,200 pretty easily, and then below 4,200, again, we could fall very, very easily. It's not out of the question. When we take a look at this 1.71 move, you can see that takes us from where we are right now down to approximately the 42.75 level. So 42.75 is definitely not out of the equation for where we're potentially playing here. That being said, one of the key things that we look at is what we call expiration, and this can also set us up for next week. And one of the nice things is that when we see a lot of red, this means that there's a lot of gamma, a lot of puts that are below us. And when people close those puts, either because they're in the money or they're not, that can actually fuel a rally. So we are seeing this dominance of puts really growing all the way through the end of the month, and we should be on the awareness here that we potentially could move higher. So with that, I'll pass it back over to my colleague Mike. And Mike, you want to walk us through some charts there?
Yeah, sounds good, Paul. I think an important statement that you made was about the volatility. When you look at that PBI chart, the 1.7% on that, obviously for trend traders, even intraday traders, you have to be able to manage your risk with that higher volatility. Obviously, we've seen that also with the VIX being up also, and how your positions can really move around intraday. So you have to be able to manage that risk. So on a SPY perspective here, as Paul was pointing out, the SPX, the 4,300 level, so 430, and then possibly the 420 on SPY. We have these PBI charts posted in the Discord, so you can pull those up. And basically, these are just looking at the lows from October and then February, where we did, have a decent amount of buying into that kind of the January 24th level. Large volume buyer there. So it's going to be important, I think, going into the next week and 2 weeks, is do we see some more buying into these lows, or do we see a lot of weakness continue and they just step away from the buying and then we break down below that level? Paul was discussing the tick. I want to show my intraday chart that we were talking about in the room. If you're looking right now in the market, it's not conducive of intermediate to longer term swings. So a lot of people are trying to make alpha, but you can do that intraday. We just have to know our levels and manage our risk. This is a trade that we're talking about on Thursday, as Paul had pointed out. Midday, the tick had turned. We had gap down. We mark our previous day high and previous day low and VWAP, and then we also marked our gamma levels. 440 was a large +1 DTE level. We opened up and went right into that level, anticipated some sort of bounce, at least maybe some coverings of those puts, but calls were not added, more puts were added. We just reflexed back to the previous day low, and then we broke this 440. And when that happens, when there's large gamma levels that price begins to move under, we anticipate some acceleration either to the upside or downside, and that's pretty much what we anticipated and saw was a larger acceleration. So I think the point is you have to step back and look at it as kind of a larger overview of the market, the conditions, and then when you zoom in intraday, that helps you be able to make your decisions intraday and stay on the right side of the market. Obviously, it's a negative gamma environment, so they're going to sell weakness, and that just accelerated this move down for that day. So being short was obviously the proper play under some other indicators that we had there. So just moving forward, I think mapping out your levels will really help you for the week. Just know those large levels, anticipate where price may react at those levels and how it may react. And if they do react, then we can look for a trade of execution either direction. Just keep an open mind, not biased, and just use the data and your own trading plan to kind of guide you. So any other comments on that, Paul?
No, I think you nailed it. Just a question for you. So given the failure of the tick to remain above the ribbon, the historical moving averages, and given that we're in a negative gamma condition and fairly deeply in a negative gamma condition, what do you recommend folks start doing in context of Tuesday, Wednesday, and beyond? Is it the sidelines? Is it from your setups that you're seeing here? Are you suggesting that perhaps shorting the bounces are prudent? I know you said not to go in there with any bias, but the entire intent of reading the market and reading the gamma condition is so that we can at least make sure that we're on the right side of the market, right? So how do you think people should be looking at Tuesday morning?
Yeah, I think that's important. I think you should continue to do your homework. If you're whatever type of trader you are, if you're a growth trader, if you're trading growth stocks, or if you're trading value stocks, you need to continue to do your homework and look for those setups of the stocks that are showing relative strength to the market. Because when the market turns, those are going to be opportunities. But as of now, if you're an intermediate swing trader to long-term trader, there's no reason to be involved in the market. Personally, you could be cash and do fine. I think the whole point of this is protecting your emotional capital and your monetary capital. And if you're on the wrong side and you're having multiple losing trades, obviously the market's telling you that you shouldn't be on the long side. Shorting bounces is absolutely, I think, the play. Via options or inverse ETFs. Inverse ETFs you can hold, days. Just know your levels and know basically the point where the market's telling you that you should be getting out of those. I agree with Paul that that I try to be neutral as possible, but the negative bias and the negative tick leads me to the short side. So I think you have to line up all your thoughts and go one by one and make 1, 2, 3, 4 or ABCD list and just look at the overall environment, and it's extremely negative right now. So, but you also have to be aware that we can get a reflex back to the upside. So you can't be so biased to not use your stops or risk management whenever the market's telling you, hey, this might be a possibility to turn. So short on that. Going into Tuesday, I would say yes. Still, everything looks negative to the downside. If weakness persists, if we could possibly move down to that 420, and then I would anticipate some type of reaction at that level.
Great. Okay. No,
all right.
I think that's great, and thanks for the summary. I think that's very consistent with what we've been talking about. So, so I want to thank everyone for watching. Any questions or comments, you can reach us, both Michael and myself, at www.gammaedge.us. That'll take you to a sign-up page, 14-day free trial, no risk to you, all the tools turned on. We've got a great group there. And then, as he said at the beginning, GammaEdge with an S on Twitter. You can also reach out there. So thanks, everyone. Have a great 3-day weekend, and we will see you next week.